Good day with another Rolling Trades podcast here at RJO Futures. My name is Dan Pavilonis, Senior Market Strategist. And today I want to talk about the WTI front month contract. And it's trading just currently around the $60 handle with futures, 59 to 60 a barrel as early as today, following a month grind lower on OPEC concerns, but also on a softer market. The near-term narrative is dominated by OPEC, and OPEC is choosing stability over further hikes, raising inventories, and geopolitics that are providing intermittent support, but not yet flipping to a broader trend. So today, I'm looking at the current market setup. Crude has slid roughly through roughly low teens % year on year, with a few percent over the past month, reflecting that the market has transitioned from tightness to a mild surplus backdrop. Front month futures are hovering around $60. CME quotes show that active front month contract in that same area, confirming the market's consolidation. We peaked below $60 a couple of times, and the curve prices into the outer years are only modestly higher than the front month, reflecting a relatively flat structure consistent with ample supply and tempered long-term demand expectations rather than a deeply backward-dated scarcity market. The shape sends signals that the market is more concerned about managing downside risk from a glut than pricing in structural shortage. And so that's where we start looking at the fundamentals behind OPEC. OPEC recently decided at the end of November to hold production steady into the first quarter of 26, effectively pausing earlier planned hikes after already adding roughly 2.9 million barrels per day back into the market this year. The message is the group prioritizes price stability and discipline, and in the face of projected surplus and softening demand. Rather than chasing the market share like it did in 2014 to 2016, several OPEC members are still producing below their official targets, highlighting constrained capacity, operational issues, even as the group talks about future quota frameworks and capacity audits. At the same time, OPEC still accounts for nearly half of global supply. So its decision to freeze output into early 26 is a key anchor for price expectations around the $60 neighborhood. And I think that's what traders are looking for right now. The market's just been kind of sideways, consolidating, but $60 seems to be a magnet. Every time we drop below 60, we're back above it. We trade a little bit above 60, we're back below it. The latest EIA data showed crude stocks are rising. Commercial petro inventories are up on the week, consistent with market expectations, but the market that has a small but persistent surplus. Refinery runs remain high, utilization at 90%, yet product stocks, especially gas and distillates, have seen mixed moves. That underscores demand is not collapsing, but also not strong enough to absorb supply without builds in crude. That's pretty important because on the demand side, the global growth indicators are soft, with China's manufacturing activity slowing, which weighs on the call that OPEC, the call for OPEC to slow down on raising production and completely stop. And that explains the alliance leaning on the cautious side, data-dependent approach. Brent averaging near the low 60s next year reinforces a view that the market expects modest demand growth and manageable acute supply risk. So looking at the technical tech side of this thing, WTI, crude, It's in a controlled downtrend this year. Price action respecting resistance in the mid 60s, carving out lower highs as macro sentiment deteriorated. If you remember back in the beginning of the year, we were looking at recession. Then Iran-Israel situation happened. We saw some volatility, higher prices, and then if you listen to my last podcast, the expectation was a break lower. Um, there seems to be a lot of volatility from the news, government shutdown, tariffs, you name it, higher 10-year yields. But the market seems to be consolidating still, and it feels like it's weighing. Supply issues are weighing going into next year, and we could see a break back down to 55. Um, I see downside momentum rather than outright reversal, which is typical of late stage sell-offs. Um, and I think with that being said, typical of late stage sell-offs, either being base or another leg lower. The curve shaped flat to slight contango structure also aligns with uh, a market in which fundamentals are a drag, but not yet panic territory. So I think if we can break below 55, we see a panic leg lower. But the other side of that is, WTI is such a deep market. It's a $6 trillion market. Only 1 trillion of that is the physical. The other 5 trillion is just all paper, which follows the 10-year yield. So over the very near term, yields look like they're kind of bottoming out and moving higher. That can be supportive for WTI. But here's several other factors that could move crude. OPEC signals any hint of core producers might consider additional cuts if prices slip, especially if they slip below 55, maybe 58 to 55 would be a clear upside catalyst, which would be or maybe renewed talk of resuming hikes in maybe Q2 of 26 with cap rallies. Details around new capacity audit and a quota framework could also change perception. The new capacity quotas and audits that are going to be in place by OPEC next year. You have geopolitical risk, supply disruptions, tensions, Russia, Ukraine. Maybe something heats up, Iran, Israel. Venezuela's taking front row seat right now. But a lot of that stuff is on the radar already. And we already see how supply is kind of trading through these things. If outages became prolonged, maybe the market would continue to move higher or break out of this consolidation range. But I think the risks to surprise disruption could trigger a short-term short covering spike in the market and prices. But I think it'll be shortly lived if that is the case. I mean, again, we still have a lot of floating crude out there. OPEC wouldn't be slowing and tightening production if they weren't trying to support the market right now. And if a slowdown in China starts to become more prevalent, I mean, there could be some issues there. If we do, for whatever reason, start to see weaker economic data in the U.S., that kind of changes the demand picture. So the macro and demand data, incoming data on global growth, especially from China and the U.S., is going to shape the expectations for 26. And particularly China could reshape the front end of the curve higher. So that's something to keep an eye on. Really just looking at this thing, it's a battleground around 60. The narrative is obvious. OPEC commentary, geopolitical supply headlines. Next few macro prints are going to determine whether consolidation resolves into the base or break lower. And look out for the 10-year yields. If we start to move higher, one thing to keep in mind here is, was it 2010 when crude hit, $160? A lot of these, it wasn't a demand issue. It was a supply issue. A lot of the banks, it was the financial crisis. Banks filled up tankers. floated them out, and that supply never came in-house, but they were using that as a supportive value or as uh, to hold value in case the dollar broke or in case, we went into a major depression or something of that nature. So that is definitely something to keep an eye on. You're seeing a lot of money into gold, the precious metals. And if this continues with expectations that inflation could come back, maybe even back a lot stronger, you may see much, much higher commodity prices, especially with crude oil too. So with that being said, today's podcast is Rolling Trades. And again, I'm Dan Pavilonis, Senior Market Strategist here at RJO Futures. You can always reach me at 800-826-1120 or shoot me an email at D, P as in Paul, A as in Adam, V as in Victor, ILONIS as in Sam at rjofutures.com. And I look forward to hearing from you. Thanks a lot.
The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance, whether actual or indicated by simulated historical tests of strategies, is not indicative of future results.